All right. Well, I think I'll go ahead and get started here. The first thing I would like to do is do introductions here for a couple of people. I am Nathan Holinsky. I'm with the University of Minnesota Extension. I'm based out of the St. Cloud Regional Office. I am reporting here today from my home. So welcome to my home as we again try to learn. I have the help or the benefit of working with both Annie Claude and Natalie Hoytel. Hopefully I pronounced that correctly. So if you two want to say anything as we get started here, introduce yourselves a little bit.
Sure. Hi, I'm Annie Claude. I'm the statewide extension educator for fruit production. And yeah, we're happy to be here. Thanks, Nathan.
And hi, I'm Natalie. I am the statewide educator for vegetable crops. Did you want us to say anything else, Nathan?
Yeah, well, I just, again, I want to introduce the rest of the team of, again, Natalie and Annie, who helped me get this program together, get the word out there, and just, again, get people to come, people to learn. That's what it's all about. So I think with that, we'll go ahead and get started. Again, if anyone has any questions as we go along, feel free to unmute yourself and shoot the question out. There should be a chat feature as well. If you can't see it, there's sometimes a more tab in your Zoom options and the chat box is in there. So if you want to use that versus the verbal or just explaining your question with unmuting yourself, whatever works, we'll make it work. So with that, here's just kind of a quick agenda here. This is a 3-part series here. So we're going to talk for about an hour. We'll be done right around 1 o'clock here this afternoon. And we're going to be going over the balance sheet of this case farm study here. We'll be joining again next week. We'll be going over the income statement, and then we'll be coming together in 2 weeks to go over the cash flow, the little bit of record keeping talk in there as well. So 3-part series. Again, today we'll be going over the balance sheet. Again, we'll be wanting to determine the farm's financial condition. We'll look at some business profitability, then also business cash flows here. But the goal of this 3-part series is the ability to determine records that are needed to make better farm management and credit decisions. So again, using these financial tools that we'll be going through and how we can use those to make better farm decisions. So the program approach here this afternoon is that we have a case farm that was sent out in that email. We'll be reading through it in a little bit, but through this case farm, we'll be using this example farm and going over their balance sheet to see what they are doing well, what there maybe could be improvements upon, and what we can learn from that balance sheet. But first off, we'll be going through what is a balance sheet, what can we comprehend, what can we take away from a balance sheet. So we'll be using this case farm to explain again these different financial record keeping ideas. So with that, we have this quote here from Rhonda Abrams. So she's the author of Successful Business Planning. So people in business usually fall into one of the 2 categories: those who are fascinated with numbers and those who are frightened by them. So the quote goes on to continue that numbers are neither magical, mysterious, nor menacing. They merely reflect on decisions that you have made previously in your business planning. Every business decision leads to a number, and taken together, these numbers form the basis of your financial forms. But numbers themselves are not decisions. You cannot pull out a number out of the thin air because the financial forms you are completing call for a specific figure on a specific line. Rather, your number should always be the result of careful planning. So hopefully with this quote in mind is kind of our mindset for today is that, again, using numbers to make better decisions. And with that, the software that our financial forms are in is this FinPack software. Some of you might be familiar with it. Some of you may not be. It's a software that's put together by the University of Minnesota. The Center for Farm Financial Management manages the software. They update it regularly. And the output of these financial forms is in this software. So maybe you've seen balance sheets before, and they're not in this FinPack format, and they look a little bit unfamiliar to you. That may be the case, but again, FinPack is the software we are using here for this program here today. So the next thing we're going to do is read through this case farm. And if we were doing this program in person, we would have these lending committee formation session here. But I'll explain that in a little bit further once we read through this case farm. So hopefully everyone here can read this case farm. Hopefully it's up on the screen, ready to see. But again, you can see that it's also attached in the email that hopefully everyone got in the last this morning, or either I sent it last week as well. But we have this case farm here. It's Easy Living Acres, and we are dealing with Fred and Wilma Smith. So they farm in central Minnesota, kind of a vague area, but that's not relevant for this case. So they own 40 acres. 9 of it is currently used in their fruit farm. So Easy Living Acres is the title of their farm. So they have 15 acres that are wooded. The rest is either pasture or tillable. Again, 9 of that being their fruit farm that they are currently using. So they have 5 acres of apples that they grow on their farm, 2 acres of blueberries, and also 2 acres of strawberries that they have on their farm. So they also sell and raise 200 broiler chickens each summer. So they raise them from chicks, until they're at harvest weight, butcher them, and then sell them through their farm that they have. So they have raised an acre of pumpkins in the past. You notice 1 acre they sell every fall, having a roadside stand. They do sell through various channels. So they do some You Pick berries. They have an on-farm store. They do go to farmers markets, and then they do sell direct to 1 local restaurant and a school that is nearby. Again, this is a fictitious farm, but hopefully it's relevant to those who are listening today. So Wilma, she's a nurse at a local hospital in town. She provides income and also health care for their family. So both Fred and Wilma, they're near 40. They have 3 children, ages 12, 10, and 8. They're all in school, and they're involved with 4-H, and they do help out in the farm when they can, where they can. They're not, again, old enough to do all of the required tasks, but they do assist when they can. So Fred and Wilma, they started their hobby farm, or as a hobby farm, about 15 years ago. They bought this 40 acres and just kind of slowly started growing and planting some other trees and berry plants. And then over the years, they've grown it to where the business is today. Wilma, she would like to join the farm full-time and quit her in-town nurse job, but they do not know if that is financially possible. So that's one of the questions we'll be going over here today, is if she can come home from the nurse and just help out with the farm. So Fred and Wilma, they would like to buy a utility tractor for their farm. Fred's been watching the markets a little bit. He figures he can buy one for about $20,000. He wants to put $3,000 down and finance the remaining $17,000. So we'll have to see if their finances are up to par enough that they can borrow some additional money. So they would also like to expand on their operating loan. They do have a small operating loan that they need every spring with some of the planting and some of the initial labor on the farm before they sell much of their fruit before it's ripe. They want the flexibility to spend what they want with a larger operating loan. So you guys that are on the call here today, you're going to be the Smith's lending review team. So again, if we were in person, we would make these 4 to 5 person groups and have you have these in-person discussions with how their Smith's farm looks. We would have you go through their balance sheets and ask. We have a set of questions that we'll be going through. But with this webinar format, we'll do the discussion more as an overall group. So hopefully everyone can spur up some conversation, and we'll discuss how the farm looks here in about 20 minutes. But again, the group will be their lending review team. So review their financial information and determine whether or not you would finance their farm operation for the 2021 crop year, with both the increase in their operating loan request and then also that tractor that they would like to purchase to help out on the farm. So this is the mindset that hopefully we will be getting in. And again, we'll go back to our PowerPoint here, go through a few more slides, and then we will go over again their farm. But first off, we will talk about, all right, so I just want to highlight, can everyone see the PowerPoint? Hopefully that's a yes. Everything kind of moved around on me, but hopefully everyone can see it. All right, looks like we're good to go. All right. So again, we're just going to explain briefly here, what is the balance sheet? What goes into a balance sheet? What can we do with a balance sheet? So a balance sheet is a snapshot of assets, liabilities, and net worth or owner's equity. So it's at a specific point in time. So the balance sheets we'll be looking at, they're going to be dated. They will have a specific date on it, but in 1 month from now or 2 months from the date on that balance sheet, it might not be 100% accurate. So we do want to keep that in mind. So just again, we'll explain that in better detail. So assets, that's everything that's owned by the business or payable to the business. So maybe you have some accounts receivable, that'll be an asset, whereas the accounts payable will be a liability. So that's all the obligations owed to others. So the biggest liability on a farm is going to be, or any business, will be loans. So whether that be an equipment loan, an operating loan, all kinds of land loans, whatever kind of loans that the farm or business has is under the liabilities. So the net worth and the owner's equity, that's your total assets minus the total liabilities. So what is left at the end of the day? What is the farm worth after all of their debts are paid off? So that's, again, a real quick summary of what a balance sheet is going to look like. So what can we measure with a balance sheet? So liquidity and solvency are the two financial ratios that we can look into, or general idea of ratios here, financial positions that we can determine by the balance sheet. So is the PowerPoint coming through fine?
From what I see, it's on the first page. It says the balance sheet, but it looks like the next couple slides are what you're talking about, like where it says it's a snapshot. We don't see that.
Okay, well, let's try this again.
Yeah, it's not in presentation mode. Like we're looking at your, I think
All right,
your,
well, it is on my end, so that's why it's confusing.
If you have two screens open, sometimes it shows up on the wrong screen.
I'm assuming that's the concern. Okay. Share screen. All right, everyone, do we see the tree, the weird money tree picture now?
Yeah.
Yes.
So if I fast forward, do you see the changes in the slides?
Yeah.
Yes.
Okay, well, can we see the assets, liabilities, and net worth?
Yes.
Yes.
Okay, well, we'll try this here. Darn technology only works when it wants to, but well, hopefully this can work. So again, I was explaining again, assets versus liabilities. Assets are what the farm owns. Liabilities is what they owe to others. Net worth is, again, the difference between the two, what's left after all debts are paid. And we can measure from the balance sheet both liquidity, which is the ability of the business to generate cash when needed. And then solvency is the overall financial risk of the business. So comparing assets with the amount of debt. So again, we'll explain this in more detail, but here's a summary of what a balance sheet's going to look like. So we'll have assets on one side, liabilities on the other. Current. So that's are going to be used up within 1 year. So again, there's kind of a time frame associated with the different types of assets and liabilities. So our current assets are going to be your cash accounts, crop inventories, the livestock held for sale, prepaid expenses, supplies, accounts receivable. So again, these will be used up within 1 year. So we do want to point out that our cash accounts hopefully won't be depleted within 1 year, but they'll be turned over. So the cash accounts that we have today, February 1st, will be different from what they will be on April 1st because we spend money and have money coming in all the time. Intermediate assets have a lifespan or a life expectancy of kind of 1 to 10 years. So that'll be machinery and equipment, and then our breeding livestock that we won't, again, be selling within 1 year. And then long-term assets, those are going to be, again, greater than 10 years. And these time frames are a little bit of a gray area. Some people say intermediate is 1 to 7, 1 to 5, 1 to 10. Again, a little bit of a gray area there. And then long-term would be anything longer than intermediate, which again would be land and buildings. Land, again, you're going to keep for a long time, and buildings are going to have a longer life expectancy of 5 to 10 years. So then we flip over to the liability side of things, and the timelines match up. Our current liabilities are going to be paid off within 1 year. Our accounts payable, maybe there's a bill for seed that we have to pay off. Again, accounts payable. Accrued expenses, your operating loans. And then another key one here is the principal due on term debt for the remainder of the year. So again, maybe we have some land payments that we have to pay this year. How much we have to pay this year is a current liability versus a long-term liability. And then our intermediate liabilities are loans with the original term from 1 to 10 years. So these will match up with our intermediate assets. So if we have a loan on a piece of machinery, that'll be an intermediate liability on that loan for buying the tractor or another piece of equipment or some other breeding livestock. Same thing here with the long-term liabilities. The loans, they'll have the original term of greater than 10 years. So if you have a loan on a piece of land that you bought, that loan will be a long-term liability in association with that land purchase. Okay, we also want to throw in personal. So especially with farming, where you live where you work, in a lot of cases, you work where you live, personal and business tend to get a little bit mixed together, and that's perfectly okay, but we do want to kind of separate some of our personal assets and personal liabilities from the farm. Maybe we want to break out the house that's, again, on the same land that the farm is based, but the house is more of a personal asset than a business asset. And same thing with some of these personal liabilities, such as credit card loans, maybe we have some student debt, other things like that, again, not related to the business, but they still are liabilities. So we just want to pay attention to that and think about that when we make a balance sheet for our own farm. Again, we can get the total liabilities and then the net worth there. Again, net worth is the difference between assets from the liabilities. How much is left after all debts are paid on the farm? And then total assets will always equal total liabilities plus net worth. So those two columns there will always be equal to one another. Again, balance sheet is a snapshot at a specific point in time. So the balance sheets we're going to be looking at today are going to be dated January 1st, 2020 and January 1st, 2021. So a balance sheet doesn't always capture the changes within a year. So we can see, I'll highlight this a little bit later on, but this farm, they buy chickens in kind of the late spring, sell them in kind of midsummer. Those don't show up on the balance sheet because January 1st of every year, they don't have the chickens because they're bought and sold throughout the year and not held year round. So again, the balance sheet doesn't capture everything, but at a specific point in time is what we're looking at. So again, the specific point in time here, it does minimize the within year changes. So we just talked about as you buy and sell some livestock, or even as the crops begin to grow, we don't have that change in the value of the land when the crops are fully ripe versus, just bare land with crops harvested. And we can measure our net worth change over a set time period. So year over year, how much is our net worth increasing? And again, we can use that to help peek at our profitability to see if we are making money on the farm or not. So again, snapshot assets of what we own, liabilities, what we owe to others. And again, net worth, the difference between the two at a specific point in time. That is what the balance sheet does. So with that, this is our sample balance sheet here for our easy living acres. So again, this is Fred and Wilma Smith. We can see, we'll walk through their balance sheet where we can see their current assets, some $12,000, current liabilities, some $7,600. Their intermediate assets are listed there. Their intermediate liabilities are also listed there. So this is what this balance sheet is going to look like that we'll walk through here for the next half hour. But then the next thing is our asset valuation. We have market value versus cost value or book value. So the market value is if you're going to sell this today, whether it be like a Craigslist ad or an auction that you're going to bring it to, what would it be worth? That's the market value. And then the other one is the cost value. So, what is your purchase price, your original purchase price minus depreciation? So these two will differ, and we'll highlight that here once we look at the actual balance sheet. And then land is an interesting case as well, because land has probably appreciated fairly significantly in the last 20 years. So we have that down there, a bullet point about how land values never changes. Never is maybe not quite the right word, but we're not going to be changing our land valuation every year, because that can really fluctuate what our net worth will be. Just because you increase your net worth from the value of the farmland from, let's just say, $2,500 an acre to $3,000 an acre, that $500 increase, or even if you increase it $1,000, that $1,000 per acre increase doesn't really mean that as an owner of the farm, you increase the value of your farm. Just throwing increased numbers in there doesn't mean you did a better job managing your farm. So we do want to pay attention to what numbers we put down. And putting down an accurate market valuation is important as well. So again, market valuation, assets estimated fair market value, a sale price that could be expected at a sold in an arm's length transaction. Again, we do want to consider selling costs, whether that be commission from an auction that you bring it to, or transportation costs when selling that item down the road. So again, keep those in mind. Advantages here, it's going to be your best estimate of solvency, because if you are going to sell these assets and all your debts are going to be paid, you want to use a realistic expectation of what the asset is worth today. Again, though we highlighted this a little bit earlier, the disadvantage is we are mixing net worth changes from earnings with market value changes. We want to make sure our net value change is truly from earnings and not just market value fluctuations. Okay, again, uses, evaluate our solvency, looking at our debt capacity, our collateral analysis, and for better external comparisons with other farms. And then another thing here, estate planning, right? If we want to look at, passing this farm down to the next generation, we want to make sure we're using realistic numbers for what this farm's worth and not what it was when we paid for it 20 years ago if we are going to be using the cost value approach. So again, we're just highlighting the different ways to value the assets on a balance sheet, because the number you put down there plays a pretty big role in how the balance sheet looks like at the end. So just a quick review here. It's a snapshot in time of what the farm owes, what it's owing to others, and then what the net worth of the owner's equity is, assets minus liabilities. Okay, measure this each year to help evaluate business gains and profitability. Okay, liquidity, solvency, and net worth change is what we'll be looking at. All right, so right now we will be looking at the actual balance sheets from the farm to see where they are at and how they look. And then hopefully we can determine a few things. So I stop sharing my screen and I will pull up these balance sheets. So hopefully this is going to work for us. All right, hopefully again we can see this. Can we see the balance sheet that I have up here? Yes, no?
Yes.
All right, sounds good. Okay, so again, we have this should be again sent in that email. So if you want to look at it on your own computer, feel free to do so, but I will share it up here for it's easier for everyone to see. We can see this is the 2020 balance sheet. So this is a full year old, 13 months old actually, because today we're already February 1st of 2021. But we can see last year, this farm, they had $800 in their checkbook. They had some just under $5,000 in prepaid expenses, whether that be some containers to put the fruit in as they sell it. We'll break down what that is as we scroll down. And they had some growing crops of $7,000. And we can see that their current liabilities are about $4,200. We scroll on down to their intermediate assets. You can see this balance sheet breaks down the difference between the cost value and their market value. So if we look at the machinery line item, they have $33,000 in their cost value approach, but the market value is actually $49,000. The market value, the depreciation they took on that equipment is a little higher than what the market value depreciation is. So again, using which valuation you use is important when writing up this balance sheet. And we can see their titled vehicles, some $14,000 there. And on their intermediate liabilities, they only have about $6,000 in comparison to the $68,000 worth of assets. Move on down here with the long-term assets, that's going to be their land. So they have $120,000 in land on the 40 acres. And then they have about $96,000 worth of buildings that they have constructed, and their loan associated with that of about $73,000 left on that loan for the land purchase that they bought about 15 years ago. Okay, we can see they do actually have some fairly significant personal assets listed here of about $120,000. personal liabilities, they have 0 listed. So we can see their net worth at the bottom here, $322,000. So after the farm pays off all their debts with what they currently own, there's $322,000 left. So not a bad number. We'll again analyze what is a good number here as we go along. So we can read through this a little bit more. We can see that here's a list of their prepaid supplies. They have some chemicals, again, some irrigation supplies, some containers for, you know, the different berries that they're selling. We can see their growing crops here. They have strawberries, some new planting of strawberries there. They do have a couple donkeys that they have for a little petting zoo when people come by to do the U-pick on their operation. They have a fairly lengthy list of machinery that they purchased. You know, again, $49,000 in market value on machinery. Scrolling down the list, they got a truck that they have for the farm. They have some coolers, some signs, different things like that for, again, about $4,700. Their land. Here's the buildings that they have. And under the buildings, they put down their fruit acres. So you can see they have the acres down here of fruit that they have on the farm. They put down separately from land into the buildings and improvements. So it is an improvement. And we can talk about it as a group as well, if that's where it belongs or not. And then under their personal real estate, they do have $120,000 that they broke out, put for the house separately from what the business value of the farm land of $120,000. So again, that's one way to do it. It's probably good to break out the house. It's hard to determine that the house is a business asset. Again, here's their loans. Here's their intermediate loans. Again, they have a little bit left on a Kubota tractor and some air blast something there that they bought a couple years ago. And then they have this loan on the land. So we can see we break out, here's the bottom of it. There's a lot of detail here. We have some deferred liabilities. So what in the world is a deferred liability? So if this farm were to liquidate today and they were like, we're sick of the fruit farm, we're done with it, and they were going to sell everything that they owned, there will be some taxes that they have to pay, right? There's capital gains on land if they sell it for more than what they originally paid for it, and also on the machinery if maybe they depreciated some of the machinery value, and if they sell it for more than their depreciated value, there's capital gains on that. So according to this rough calculation, it's about $11,000 that they would pay in taxes if they sold the farm today. So that's what that deferred liabilities means. So they don't necessarily have to pay that today if they plan on continuing the farm operation, but down the road that may become a very real number when they go to sell it, either to someone else or maybe their kids want to come into the farm and take over down the road. Okay. Any questions on this first balance sheet, right? The one question in the chat is asking about the growing crops. So I'll go back to that item. Any other questions before we dig into this one from the group? Again, you can either type it in the chat box or unmute yourself and talk to the group. Whatever works for you guys will work for me. So with that, I'll explain this growing crops. And this is a question for the group as well. Is this the proper place to put growing crops? So they have some strawberries. They have 2 acres that they valued at $4,000, $2,000 per acre there on strawberries. And then they have 1.5 acres of new berries that they planted. Okay, so they have these new strawberry plants. Again, they valued at $2,000 per acre of new strawberries that they planted here, either in probably planted in 2019 actually, because this is January 1st, 2020 balance sheet. So if you guys were going to plant some new perennial crop, would you put it in that growing crops category? We can see that for their other crops, you know, the apples and the blueberries, they put in under the improvements category and not under the growing crops. So that's a little bit confusing. You know, why did they switch that up? And to be honest, I did create this balance sheet, but I put a couple things in there just to get the group thinking about, is that truly where it belongs? You know, should they put that strawberry section into this, you know, improvements on the land? You know, especially the producing strawberries, you know, is that really a growing crop? Because that is under the current asset category. And if the strawberries are producing year over year for several years, they're probably more so an intermediate or a long-term asset than a current asset. You know, the growing crops, you would probably tend to think of, you know, your corn and soybeans or your peppers or pumpkins that 1 year and they're done. You have to replant every spring, but strawberries, you don't necessarily have to replant them every single year. So again, another thing for the group to think about here is where these different line items truly belong. So with that, we'll roll into their 2021 balance sheet. So this is from a month ago, and we can relate, we can see how they change from 1 year to the next. So the current assets. So before, I believe their checking account only had about $1,000 in it. Here it has about $5,000. And then the prepaid expenses and supplies, again, is about $6,800. And you can see the growing crops here on this line item is zero. So they moved that strawberries from growing crops to somewhere else. And again, is that the right thing to do? You know, that's just, again, the group, hopefully we can have a little discussion on where that truly does belong. Again, you can see they have a little bit of current liabilities. Their machinery schedule is pretty similar. Again, their land didn't really change at all. It looks pretty darn similar for the most part. Again, hopefully the group can have a little bit of discussion here in some of the changes. But the biggest change I think we could say is the change from that growing crops of the strawberries to, you know, if we scroll on down the list, where did they put it? Again, it looks like they bought a Polaris Ranger in the last year in 2020, valued at $11,000. So that's another change. But it looks like they put strawberries into their intermediate assets, where they put the blueberries and their apples and their long-term assets. So, you know, is that the proper way to do it? You know, if you guys had, again, some strawberries on your farm, where would you put their worth? Intermediate or long-term? Pretty quiet from the group, but again, hopefully you guys can think on these things. So the one response was intermediate or short. Okay, so maybe intermediate is where strawberries do belong versus long-term in respect with apples and blueberries. Okay, so again, we can look at their deferred liabilities there as well. Before, I believe it was $11,000, so it increased either $1,000 or a little over $1,000. Their deferred liabilities. And again, that's kind of a hypothetical number, but if they are looking at either doing some form of liquidation or transferring the farm to the next generation, that is a very realistic number, and we can't forget about that number. We just have to understand what it truly means. Okay, so that is, again, how this balance sheet looks. It's one example of what, again, this fruit farm, where they place their different assets and liabilities. So I'm going to go back now we are going to look at a set of questions. So can you guys read the questions that I have? So the first one, again, strengths and weaknesses of their balance sheet. We looked at two of them, right? Both a 2020 and a 2021 balance sheet. What are some of the strengths and weaknesses? Right? If we did look up, they had a decent net worth of roughly $320,000. It looks like for each of the separate current, intermediate, and long-term categories, they had more assets than liabilities, right? So they were able to, if necessary, be able to pay off those loans if they had to sell some stuff. So again, hopefully we can see that. It's a fairly strong balance sheet. Again, the numbers are not horrible, right? But what does that really mean? We'll go over some of this in a little more detail once we get back to the PowerPoint. But as a group, are you ready to tell this Fred and Wilma yes or no to their tractor purchase request, right? They wanted to buy a tractor this spring, for around $20,000. Do you guys think they can afford to do so? Or would we like to see some more financial information from the farm? Okay, so again, would you give them a loan? Would you deny their loan request? And if you're not ready to make this loan decision, what else would you like to see? So hopefully, again, the answer is easily answerable with the way this program is set up. With next week, we're going to be talking about their income statement. In 2 weeks, we'll be talking about their cash flow, which hopefully with that additional information, we can make a stronger loan decision. And just with more information, we can get a better understanding of how this farm is operating. Just because they own equipment and don't have a ton of debt doesn't mean they can afford to take on more, or it doesn't really mean that they're a very profitable farm either. So hopefully with the income statement, we can look at their profit levels. I think we should just discuss the questions as a group as a whole. I think to do small breakouts would be kind of difficult in our Zoom format. So if you guys have some comments, please throw them in the chat box. Unmute yourself and say them out loud is perfectly okay as well. The whole point of this, again, is just to get people thinking about what balance sheets look like and what goes into the balance sheet, and really understanding, what is the point of a balance sheet. And hopefully the only balance sheet you've seen is not one that the bank has made for you, right? Maybe you go in for a loan decision and they're like, all right, we'll put down your assets and your liabilities and see what we think. Creating a balance sheet for yourself is a good idea as well. And I know FinPack is the software we're using for this program here this afternoon, but you could do a simple Excel file balance sheet. And once this class, do I recommend using FinPack? So FinPack is a U of M software, and it is pretty easy to use. That's the big selling point of FinPack. Is it's easy to use, and it does a lot of the output for you. It does some of the loan calculations. It also does some of the analysis for you in it. So it's a pretty nice tool. There is a fee to use FinPack. It does cost about $149 a year, but they do have a free option where you can only make a balance sheet. So if all you care about is the balance sheet, you can use FinPack for free with only making the balance sheet, not able to be making the income statement, cash flow, or some of the other long-term projections that FinPack is capable of. So there is a FinPack free option that I would like to point out as well. And again, Excel file, I will share that when this class is finished. we have this 3-part series that we'll be going through, and I'll share an Excel file that is pre-set up to use a balance sheet approach. So the data in FinPack should be able to, the data will be saved. So like when you pay $149 this year and then you pay for it next year, you don't have to re-put in all of that FinPack information. It'll save the file so that you just open it and should go up. And what about the free version? I think the data should save in there as well. I'm not super familiar with it. I have the paid for version of FinPack on my laptop for work. So I use that instead of the free one. So I'm not quite as familiar with it, but I can look into that, and I can send the link for that free version to all registered participants of this class, because I do think that's a good option. It's easy to use FinPack because the layout of a balance sheet is pre-made. You just have to move things around. So I'll find the link and how to use that free version, and I'll send an email to the registered participants in the class here and hopefully explain how that's useful to use on their own farm. Any other questions? Otherwise, we'll get back to the PowerPoint and wrap up this section here today. All right, hopefully everyone can see the PowerPoint up here. And again, we'll walk through this in another 10, 15 minutes, and we're already at about 10 to 1 here. So can we see this PowerPoint that we have? Hopefully that's a yes.
Yep, we can see it.
All right, sounds good. So again, these are the things that we can calculate from that balance sheet. The current position, the financial structure, we'll look at some solvency, and then our net worth change. So again, current position, that's going to be looking at our current assets versus current liabilities. That's going to look into our liquidity. What is that, right? So our current assets for the 2021 balance sheet were $12,000, and current liabilities were about $7,600. So how do those stack up? So first off here, working capital. So working capital is going to be your current assets minus your current liabilities. So in this example, it's $4,545. So right, if they had to pay all of their current liabilities today, they would have a little bit left, right? Their working capital is positive number. That's a good start. $4,500. Is that big enough? A little bit to be determined here, but this is a very important number with financial risk management. So it will be reduced by cash capital purchases, and then also family withdrawals are going to come from this number. The current ratio, that's your current assets divided by current liabilities. So again, here that $12,000 and that $7,600 in current liabilities equals 1.6. Okay, so again, measures the ability to generate cash to meet farm business obligations. So includes the ability to pay for family living, taxes, and debt payments. Again, that's where those numbers are coming from the balance sheet. So where's the equity in this? Our assets matched, with liabilities. We kind of talked about this already, but each of their asset categories in the different time frames were higher than their liabilities. We can see their total assets are about $420,000, with their total liabilities only about $100,000. So they definitely have assets greater than liabilities. So we take our total debt to asset ratio, again, is 24%. So we'll peek at it in just a couple minutes if that's a good number or not. But again, this is an important solvency numbers. So again, provides a look at the balance sheet structure. Can all the debts be paid if the assets were sold? And then net worth change. And we also want to look at, is this net worth change? Is it from earnings, or is it from market value being increased? So we'll just peek at here the net worth on their 2021 balance sheet, $325,345. Their 2020 balance sheet was $322,570. So their net worth change increased $2,700. So it's a positive number, which is good. That's less than a 1% increase. And we'll again explain if that's good or bad. So in the email that I sent out that hopefully everyone received, they had this financial farm finance scorecard in there. And we'll walk through this here in the next few minutes to wrap up our talk here this afternoon. But we can see we have this red bar, yellow bar, green bar, where these financial ratios are explained if they're in a vulnerable position, an okay position, or in a pretty strong position. So again, we talked about the liquidity measures. The current ratio, they were at 1.6, which puts them kind of right in the middle. They're not vulnerable, but it's not a super strong number of a current ratio of 1.6. We want to see that number a little bit higher. Above 2 would be preferred. Again, working capital, $4,500. Is that a super strong number? There's not this stoplight analysis with this number here because it really does depend on the size of the farm, right? If this farm has, $1 million in gross revenue, $4,500, pretty darn small and probably not sufficient. If this farm, the revenue is only about, $20,000, $30,000, $40,000, it's probably a pretty solid number. And again, our balance sheet doesn't talk about revenue. That's where the income statement is important. And hopefully everyone will join us again next week to go over the additional financial analysis to say, what is our revenue? What is our profitability? So again, we can see here's the stoplight approach of if we're in the red, look at maybe selling some assets, re-amortizing some loans. Again, we can see maintain the cash reserves in the bank and different things to improve liquidity. So solvency, again, the solvency ratios here, we want to see that below 30%. This farm's at 24%, puts them in a pretty strong solvency ratio. So another way to look at this number, this is how much the bank owns of the farm. So in this case, for this Easy Living Acres, the bank owns 24% of the farm in terms of their debt share. So that's obviously not too bad of a number. They're in a pretty strong position here. We really don't want to see that number, especially above 60%. But again, we want to see the farmer owning the majority of their farm compared with the bank. Okay, again, here's the same stoplight analysis of ways to improve things. Again, we need to, if we were in the red, increasing farm profitabilities. If we're in the yellow, maintaining assets in good repair. And we're in the green in this case, and we can look at, carefully considering some capital purchases, maintain farm profitability to, again, maintain a strong solvency ratio. Okay, again, snapshot of assets, liability, and equity at a specific point in time. All right, we did have a question here about, does the FinPac do the stoplight analysis? And the answer is yes, it does. So at the bottom of that balance sheet, I'm not in the one that I submitted because I just wanted to make it a little shorter for our analysis today. But if you get the full balance sheet printout from FinPac, it will have that stoplight analysis built into it. And you can see if your current ratio is in the red, the yellow, or the green. So FinPac does have the capabilities of showing the stoplight analysis, which is a very simple way of knowing, do I have room for improvement or am I doing pretty good as is? And there is a question about, does extension offer assistance? I think we do. Extension does provide a lot of services to help educate, which we're hopefully doing today, and expand on some of those FinPac knowledge to the public. So I would say yes, call your local extension office. And also I'll send that free link out to the balance sheet only option and just play around with the software. If you've never used it before, it's not going to be very familiar, but just throwing in some numbers and see where that looks like is a good idea as well. But again, wrapping up our balance sheet review here, a snapshot in time. Again, it's a data of what we own, what we owe to others, specifically the bank, and then what's left over at the end of the day. What is our owner's equity? Measure this each year to evaluate our farm business gains to see where we're at. Again, here's a quick snapshot of what this balance sheet looks like. Assets on one side, liabilities on the other. If we've ever taken some accounting classes, they call this the T chart, where you can see assets on one side, liabilities on the other. We can look at liquidity, solvency, and net worth change here for when comparing two separate balance sheets. And again, case farm takeaways. So the current ratio in 2021, it was 1.6. In 2020, it was actually 2.37. So we slipped, pretty strong, like a full half a point there. And we should look at, we're kind of wrapping up today's talk. But why did that slip as much as it did? What happened that we lost that much of our current ratio? Working capital is also down about $1,200. So, what happened there, right? They did purchase that Polaris Ranger in 2020. So maybe that burnt up some of their current assets by paying down in some cash for that Polaris Ranger. That's one thing that we need to look at. We don't have the time today to do a stronger analysis, but things we just want to point out. Debt to asset ratio, pretty darn constant there, increased just about 1 point from 2020 into 21. Again, we want that debt to asset ratio to be smaller, but that 1% increase is probably nothing to get too alarmed about. It's still a pretty strong number. Again, net worth change, little bit of growth. We had $2,700 in growth in net worth. So a increase is a good thing. Limited gain is better than a negative gain. So can't complain about that. And again, intermediate and long-term equity. We didn't look real closely at their interest rates, but just understanding where they're at. Interest rates today are historically low, but if you set up your mortgage 10, 15, 20 years ago, maybe you didn't capture as low of rates that they are today. So maybe there is room for some refinancing to save some on interest expense. The current situation is tightening, and we just want to watch that again moving forward. Okay, so to continue improving liquidity and solvency, again, be strategic with capital asset decisions. Look at increasing farm income. Any questions here? We're already at 1 o'clock. It was kind of quick here today, but hopefully we got people thinking about the balance sheet, what goes into a balance sheet, and again, it's the things we can calculate from that balance sheet to help make better farm management decisions. So that's the wrap of our talk here today. Again, feel free to shoot out any questions either through the chat box or by unmuting yourself, and we will get those answered. And if there's none more, we'll wrap up this talk. And again, please meet us again next Monday from noon to 1, and we'll talk about the same case farm, but we'll look at their income statement to determine how much money they really did make in 2020. Again, having a strong balance sheet doesn't necessarily mean you made a lot of money last year. So again, hopefully this was helpful. When this 3-part series is wrapped up, I can share any more information, or I can share the PowerPoint if you guys would like. Please respond if you want to contact me. Send me an email from the one that I sent out with the link for this Zoom webinar. So just send me an additional email with any other questions. I'm here to hopefully answer all of them. And if you have no further questions, thank you for joining us today, and feel free to log off if you have no further questions.